This is the 17th installment to the series entitled Build Your Business into an Asset of Value. Operational assets are used by the business to produce its products or deliver its services. Acquiring an operational asset should be seen as an investment. After all, the business employs capital, either its own or from external sources, to acquire an asset that it uses to produce its products or deliver its services. Therefore, an operational asset, in a sense, pays for itself. Examples of operational assets include machinery, tools, information technology, hardware and software, vehicles and furniture. What differentiates operational assets from fixed assets is that the former almost always depreciates in value, whereas the latter, typically commercial property, almost always appreciates in value. In fact, businesses usually qualify for tax relief in respect to the depreciation of operational assets. Your accountant will be able to give you more information about what tax deductions your business will qualify for. Consequently, operational assets do not contribute to the balance sheet value of the business, since these assets depreciate. But there is more to owning an operational asset than its book value, the value reflected in the statement of financial position. Certain types of operational assets retain their utility, their usefulness, long after the accountant has written off the asset in the financial statements. Hand tools, think of a hammer, may be used for decades, but a used hand tool has almost no monetary value. But other types of assets not only depreciate rapidly, that is, lose value, but soon become redundant also. Think of information technology like a laptop computer that loses most of its monetary value within the first 2 years of ownership, but also soon becomes outdated and in need of upgrading. A business manager must consider both the monetary value and the utility of operational assets when deciding on what method of funding is most appropriate. In this chapter, I consider the following alternative sources of funding for operational assets: cash reserves, a business loan, asset finance, and a pure rental. Cash reserves. The owners of a business usually draw an income in the form of directors' remuneration from the business, which is reflected under the operational expenses in the profit and loss statement. But a shareholder, usually also the director, may also share in the profits of the business by way of dividends from net profits. Savvy business owners understand that a portion of profits should be retained in the business as cash reserves. A business owner may decide to acquire operational assets by using a portion of the cash reserves. But this decision comes with a cost, an opportunity cost, since cash reserves can also be used for other purposes, including as funding for trading activities. The business owner must decide if committing cash reserves to operational assets will yield a better return than funding cost of sales, with which the business can grow its sales revenues. using cash reserves to acquire low-value assets that retain their utility over a long period of time makes sense to me. But committing a large amount of cash reserves to assets that depreciate, and particularly assets with a limited lifespan that must be replaced over the medium term, makes less sense to me. More so if the business owner is confident about growing revenues by investing cash reserves in trading activities, as opposed to locking cash into operational assets. A business loan. In Chapter 16, I introduced you to an unsecured business loan. Unsecured since no asset serves as collateral for the debt. However, financiers will almost always insist that the directors of the business accept personal responsibility for the loan by way of a personal surety. With a limited capital or loan value, typically a short-term loan over a few weeks or months and offered at very high rates of finance. Using an unsecured business loan is probably the most inappropriate finance solution for operational assets. But there may be circumstances in which the business owner has no other choice. In the following section, I introduce asset finance as a means of funding operational assets. Financiers offering asset finance do so in part because of the collateral value of the asset that is being funded. There may be circumstances where the business needs funding for an operational asset, but financiers are unwilling to provide asset finance either because they don't accept the collateral value of the asset or because they don't want to transact with the supplier of the operational asset. Asset finance. Asset finance provides funding for a particular asset over a specified loan term at a fixed or variable rate of finance. Financiers will consider the collateral value of an asset before approving an application for asset finance. Asset finance may take the form of a term loan or a lease. A term loan is a loan over a specified term at a fixed or variable rate of finance with the added requirement of a deposit and may include a residual, sometimes called a balloon payment at the end of the term. As mentioned before, please don't get hung up on terminology. Financiers come up with various terms for what is essentially a term loan. Your job as business manager is to get past all the hype and understand the mechanics of the finance solution so that you can make an informed decision. It is important to understand that the business becomes the owner of the asset at inception of the transaction. The asset will be reflected under non-current assets in the statement of financial position, and the accountant will seek to depreciate the asset from the second year of ownership. A disadvantage of term loans is that the financier often insists on a deposit, typically around 20% of the asset value. I recommend the use of a term loan as a finance solution for operational assets that retain their utility for a long time. Examples of such assets may include certain types of tools, furniture and furnishings. A lease. Confusingly, a lease is often referred to as a rental. I address pure rental in a minute. A lease is a financing solution where the financier agrees to acquire a particular asset on behalf of a borrower who agrees to pay off the debt over a specified term at a fixed or variable rate of finance. A lease may take on the form of a finance lease, where the asset does not become the ownership of the borrower, or a capital lease, where the asset becomes the ownership of the borrower at the end of the loan term. Leasing, both capital and finance leases, were for the longest time referred to as a form of off-balance sheet finance, since in the past this type of solution did not reflect as debt in the financial statements of the business. Legislative changes now prescribe the inclusion of these finance arrangements in the company financial statements. You should consult with your accountant for more information. A pure rental. A pure rental agreement is just that, a pure rental. Don't confuse rentals with leasing. Some financiers confusingly refer to a lease as a rental. A pure rental is not a financial product. The owner of the asset rents the equipment to the business over a specified rental term, which may be for as little as a day to a few years. This is a great solution if you need the use of an asset for a short time and you don't mind used assets. As this is not a form of debt finance, using renting as a solution does not impact your credit lines at all. This is not a form of debt. And best of all, insurance and maintenance are commonly included in the monthly rental. In conclusion, the usable lifespan and the pace at which the asset depreciates are both factors that the business owner should consider when deciding on which type of funding solution is appropriate for acquiring operational assets. Thank you for watching. To access the full series, visit Constructum Online Learning on YouTube or click on the link in the post.